AT&T employees, and welcome. Thank you so much for being here with us today. I'm Sam, and I moderate these presentations. In just a second, we are going to be joined by Patrick Ray, one of our financial advisors who specializes in AT&T retirement plans. This webinar today is specifically formulated for AT&T craft employees. Patrick is going to be going over how the interest rates may or may not affect your craft pension when you decide to retire from AT&T. I apologize in advance. We will not have time today to answer your questions after the presentation, but I encourage you to still ask away. It is completely anonymous, and I'll make sure one of our AT&T focused financial advisors can reach out to you afterward to answer those with you through phone or email. As we wait for just a couple other people to trickle in, I'd like to quickly remind you we are not affiliated nor endorsed whatsoever by AT&T. We are a completely independent group of financial advisors, so please keep that in mind as you're listening along. And lastly, while Patrick is speaking, you will see me entering some links. They will pop up right above your head there. They're going to guide you to various resources we have available, one of which will be our calendar, where you can book a complimentary 15-minute block of time to speak to one of our AT&T financial advisors about your concerns, your questions. You can start or get updated on your retirement planning. You can also follow us on YouTube or LinkedIn. We post tons of AT&T related content weekly, and we really think you'd get some value out of it if you considered giving us that follow. And with all of that out of the way, we are now going to jump to Patrick Ray.
Hello, everyone, and welcome to today's presentation. My name is Patrick Ray. I'm one of the senior retirement advisors here with the Retirement Group and the Wealth Enhancement Group. And today I'm going to be talking about the AT&T Craft pension. We're going to discuss the pension eligibility, and then we're going to talk a little bit about the pension itself and how it's calculated. We're going to go through a couple of examples of what it looks like if this applies to you and what it might mean to you from a retirement planning perspective. So the pension benefit overview. Let's talk about service pension eligibility. Then we're going to talk a little bit about bridging, and then we're going to discuss the plan itself, both on the DB side and the cash balance version, and then go through a couple of examples for you to look over. So first and foremost, the service pension eligibility, or what they refer to in the company as modified 75. This is an incredibly important rule that must be met at a specific measure or in a specific way. And so to give you an idea, I have met people over the years who have been age and service adding up to 75. Like, for example, a 48-year-old who has 27 years of service. Those two numbers add up to 75. But in fact, they are not service pension eligible. And it's because there is a modified rule to this, meaning that you must fulfill one or both of these, assuming that they apply. So for example, you have to be at least 30 years of service at any age, and you will become automatically service pension eligible. So if you have 30 years of service, you're automatically eligible. But if you're not 30 years of service, you must fall into one of these other three categories, meaning that you must be at least 50 with at least 25 years of service, or 55 years of age with at least 20 years of service, or 65 and 10. So one of those three additional rules, assuming that you check the box on both sides, you will become eligible under the modified 75 rule. Now, what does that actually mean to you? Well, it depends. If there's bridging involved, there's an added level of complexity to the calculation, because you could, for example, leave the company and then come back. You could actually leave the company because you became outsourced or surplused and then actually got your job back within a certain window of time. Maybe you changed from a craft employee and ultimately got promoted to be management and fulfilled your remaining years as a manager, or you did the opposite and you went from management into the craft world. So assuming that some and or all of these things apply to you, the question is, which one of these benefits means the most to you? So let's talk about the defined benefit pension itself. So defined benefit using pension bands, which is under the craft rule, is a bargain for plan itself by the certain union that you otherwise would be represented by. And it's relevant to your pension band formula. So in other words, they give you a pension band based on your craft service, and they multiply your pension band by your NCS date, or in short, NCS stands for net credited service. So what that equals is a monthly annuity. And assuming that you have no age penalties, that's what you would be paid on a monthly basis under the single life annuity format. However, if you fall into the age penalty category, which we'll talk a little bit about here in a moment, then you would have to remove that discount to have a net figure as to what your monthly annuity would actually be. So the pension band factor is based on your job title. Okay. As I mentioned, NCS stands for net credited service, which is usually the years that you have worked for the company. And then your monthly annuity can be converted, actually, as it turns out, into a lump sum, which is calculated based on the current interest rate environment and IRS life expectancy tables. So we'll talk a little bit about that here in just a minute. But as I mentioned, AP, or otherwise known as age penalties, would affect that actual number that you would ultimately get. So let's take a look at the age penalties as an example. So if you're age 55 and you're service pension eligible, you have no penalties on your pension plan. Okay. Or if you're 54, there's a discount, and you can see the discount is relevant to about a 6% decrease down to age 50. So if you start at 50 years old, you're going to have roughly 70% of your pension available to you. And then each and every year, you'll gain 6% roughly on your pension plan until you age out of the plan penalties, which is at age 55. Now, one of the unique rules that applies is if you are 30 years of service, then not only are you automatically service pension eligible, but you also have no age penalties, regardless of what your age is. So, to give you an idea, we'll run through a couple of examples. So, in example number one, Joe, age 54, was hired at the company in 1994 and participates in the DB pension plan. His position is a cable splicing technician. The pension band for that job title is 120, and so the monthly benefit in this case for a pension band at 120 is $71.75 per year of service. This person has 31 years of service on the payroll between 1994 and 2025 in today's terms. So what we would do here is we would take the monthly benefit, which is 71.75 based on his pension band, and then multiply that by the 31 years of service, and it comes out to 2224.25 per year. That's the single life annuity version. So we're going to talk about the different plan options here in just a moment on what that might mean to you. So that is example number one. Now, if we look at example number two, Mary, who is also 54, was hired at the company in 2000, and she also participates in the DB pension plan. She's also a cable splicing technician, which means she has a pension band of 120, just like the previous example. And that monthly benefit, as we talked about, is $71.75 per year. But in this case, she has 25 years of service, which means that we would take her monthly pension by the $71.75 multiplied by the 25 years of service, which also includes a penalty in her case of 6%. So we would multiply that number by 0.94, which comes out to 1686.13. And to remind you, the reason that this 0.94 exists is because, albeit she's service pension eligible, she's under the age of 55. And for a quick minute, we'll go back to the pension penalties, which is at 54, or in this case, she's not yet 55. She has a 6% penalty, which is where that 0.94% in this calculation comes from. So multiply the pension band, which is $71.75 for pension band 120, times 25 years of service, times the 0.94, comes out to that 1686.13. Now, I keep referring to the single life annuity format, which is the sum default rule on what your pension payout would be. But there's not that only option. Okay, so if you're married, as an example, you could take the joint life annuity option, and there are different criterias on how much your spouse would get paid in the event that you suffer an untimely death. And then you can also, as we talked earlier, convert that monthly pension payment into a lump sum. So depending on which one of these scenarios might mean the most to you, if you're unsure, this is the significance of the planning process where maybe you're in the penalty phase and we don't know which option to take. This is the importance of doing a financial plan, okay? And we're going to talk a little bit about that here towards the end of the presentation. But in a nutshell, if you decide that not only the annuity payments are the only option, but you want to understand what the lump sum means to you, you need to understand how the interest rate affects your pension amount. And so if you can picture this teeter-totter, the interest rate environment has an inverse relationship to your lump sum. So in a perfect world, you would want to leave in the lowest interest rate environment possible because it would push out the most money to you from a lump sum perspective. So we're going to talk about the AT&T interest rates and the discussion of what is referred to as a look back period to kind of give you a visual of the best environment for you to assume what best pension option is when you actually decide to pull the trigger and retire. So the look back period refers to a historical time frame that's utilized for observing interest rates. And companies use a look back period to provide employees for or with crucial interest rate data to give them a preemptive understanding of what it might be best for them or timing wise when to leave the payroll. So, under higher historical interest rate, typically that correlates to a smaller lump sum and vice versa. As I mentioned, these things have the interest rate environment has an inverse relationship to the lump sum. So, the historical interest rates trend and during this window give you an impact of what the current lump sum value would ultimately be. And a stable and predictable tool in the pension calculations is kind of a necessity if you're trying to determine when the best time for you to retire is. And the beauty of this is the rate is determined in the November timeframe of the year prior to you leaving the payroll. So if you leave in 2025, anytime in the tax year of 2025, we're going to be utilizing the interest rate segments that were applied in November of 2024. So let's take a look at what those actually look like. All right. So here we are in January of 2025, and you have an interest rate segment of segment 1, 2, and 3 of 4.74, 5.55, and 5.92. Now, as a quick understanding, the three different segments of the corporate bond structure apply to your pension lump sum calculation differently. So to give you an idea, the first segment is dealing with the first 5 years of your retirement. The second segment is dealing with years 6 through 20. And then the third segment is dealing with years 21 plus. So the younger that you are, the more that these second and third segments would actually impact your lump sum factor. Okay. But if we look at the November of 2024 rates, this is applicable, as I mentioned, for anyone who retires in the tax year of 2025. So this shows you a segment rate of 4.66 versus 5.25 in the second segment and 5.57 in the third segment. So what this is telling you is the interest rates are trending upward, which means that your lump sum is going down by definition. Remember that inverse relationship. The interest rates go up, your lump sum goes down. So by default, if you were thinking about retiring in 2025 and you were deciding on if you should take the lump sum and decide to do that, you may want to consider leaving the payroll in 2025 because the payment for your pension plan would be higher than it would be if you left in 2026. So, of course, again, as the significance goes, you need to do some planning for that, which we'll talk about here in just a moment. Well, let's talk about the cash balance plan for just a second. And this is provided to new hires in a certain business unit, for example, AT&T Mobility. And the cash balance formula works as the sum of all crediting, which equals your lump sum. And then there's a single life annuity format, which is equal to your lump sum divided by monthly payment factors. So we're going to talk about the pension band credits, the interest rate credit, and what the cash balance to lump sum monthly annuity payment looks like. So to give you an idea, the annual pension band credits look like this. So depending on your pension band and your net years of service or your net credited service, it would give you the factor of what would be credited to your cash balance plan. And then looking at the interest rate credit, what happens is the plans are crediting your cash balance account with interest rate credits. And so at the end of each crediting period, the amount of your cash balances at the beginning is credited by that amount plus interest. And so the interest crediting is set by the plan itself. So there's an equation or a calculation involved for that. And it looks like this. So if we take this example and we assume that your cash balance account at the beginning of the calendar year is 200,000, all right? And then we further assume that your basic benefit credit, which is BBC in short, is 3150 for pension band 128 because this person has 15 to 19 years of service. We further assume that the 30-year US Treasury rate is 4%. So the amount that's interest credited to your cash balance plan for the year would be 8,000. The way you figure that out is you take the original balance multiplied by that US Treasury 30-year rate, which is 4%. So that equates to 8,000. And then the balance of the cash balance plan at the end of the calendar year would be credited also by the annual basic benefit credit. So you started with 200, your annual basic benefit credit, in this case, because this pension band in this example is 128 with 15 to 19 years of service, was 3150 plus the $8,000 of interest rate credits gives this person an ending year balance of $211,150. Now, when you try to convert this cash balance to a lump sum, or a monthly annuity, basically there's a table to utilize and there's a factor involved depending on how many years of service that you have and how old you are. And so you might notice that as this sheet goes in length for years and over time from age, that these factors become lower. And that's because you're closer from a calculation perspective to life expectancy. And so, while all of these things may seem somewhat overwhelming or confusing from a calculation perspective, the reality is planning for retirement is the biggest takeaway from what we have to discuss. So, we can talk all day long about the way the pension is calculated and the rules and the crediting strategies and what the interest rates are and how that affects the difference between your lump sum payment and if you should otherwise consider taking the annuity payment. But if you're over the age of 50, it's statistically proven that you don't have a written financial plan because we know 74% of the people over the age of 50 don't have a written financial plan for their retirement. And frankly, there's no reason for that because firms like ours use this as a way to introduce their services to you in case you're looking for a partner to transition into retirement and get some help with your benefits and how that works and what it looks like from an investment perspective. So the retirement group has a team of advisors with me, myself, and my colleagues of over 150 years of experience in working with Fortune 100 employees and specifically AT&T employees. And we have offices all across the country, and we have an intimate knowledge of your AT&T savings plan, your pension benefits, and any medical plans that you may otherwise qualify for from a retirement perspective. And so we would encourage you to take advantage of our complimentary cash flow analysis so that you aren't one of those statistics that don't have a written financial plan. And this is something that if you're willing to spend some time with us, we're willing to spend some time with you to introduce our services to you and provide you with this complimentary cash flow analysis so that you have a better understanding of what your financial and retirement picture looks like. So if you're open to scheduling a meeting with us, you can do that and reach out to us in a number of ways. You can email us at info@theretirementgroup.com. You can call our 800 number, which is 800 900 5867. You can take a picture of this QR code to the left, which is going to get you to access to a calendar where you can pick a time that works best for you. And one of our advisors, maybe me, would ultimately spend some time with you to learn about your situation and try to see what they can do to help. And then if you're not already following us on our LinkedIn page, I encourage you to absolutely do this. This is a ton of detailed and current and up-to-date information that we share with AT&T specific people on this page so that it would provide you a very good and relevant reference to stay on top of what's going on in the community and what we do to help our AT&T folks. And so in the end, in my 26 years of helping people transition into a successful retirement, there's no one that we've ever talked to that retired with too much money, right? There's also no one that we ever talked to that started their retirement planning process too soon. So we encourage you to reach out to us in the event that you're open or interested in getting some help because we're delighted to give you our experience and our plethora of knowledge in the AT&T plan specifically to help you. And so with that, I'll let you go for the afternoon. I appreciate your attention and I hope you found some value in spending some time with me today. And until next time, we'll see you, okay? Take care.